Introduction. As part of our accounting foundation classes, we have already discussed in detail the definition of accounting and developed an understanding of accounting through its process. We now move to the next important topic in accounting, namely systems of accounting. Broadly, accounting systems are classified into single entry system of accounting, double entry system of accounting. Let us study each of these systems in detail. Origin of single entry system. In ancient times, business activities were carried out on a very small scale. Most businesses were owned by individual traders or family enterprises. Business transactions during this period were few in number, mostly carried out on a cash basis, limited to buying and selling of goods. There was no legal or statutory requirement to maintain detailed accounting records. Therefore, businessmen recorded only the most essential information required for their personal reference. This practice led to the origin of the single entry system of accounting. Stages in the evolution of single entry system. 1. Memorandum or memory stage. This was the earliest stage of accounting. Transactions were remembered mentally or written down casually. No systematic records were maintained. The main objective was to avoid forgetting important transactions. This method became unreliable as the volume of transactions increased. 2. Cash record stage. Traders began maintaining a cash record. Only cash receipts and cash payments were recorded. Credit transactions were mostly ignored. This stage helped in controlling cash but failed to provide information about credit dealings. Personal accounts stage. With the increase in credit transactions, traders started maintaining amounts receivable from customers, debtors, amounts payable to suppliers, creditors. Personal accounts of debtors and creditors were maintained. However, real and nominal accounts were not maintained, making the system incomplete. 4. Capital comparison stage. Traders felt the need to know whether they were earning profit or incurring loss. Capital at the beginning and end of the period was compared. Profit was treated as an increase in capital. Loss was treated as a decrease in capital. This gave rise to the statement of a face method. Organized single entry system. Cash book and personal accounts became common. Capital and drawings were recorded in a rough manner. Profit and financial position were estimated, not accurately calculated. This system still lacked dual aspect concept, trial balance, complete final accounts. This stage represents the modern form of the single entry system. Definition of single entry system. According to R. N. Carter, single entry system is a system of bookkeeping in which only one aspect of transactions is recorded. Meaning of single entry system. The single entry system of accounting is a method of bookkeeping in which only one aspect of a transaction is recorded, instead of recording both debit and credit aspects. Under this system, transactions are recorded in a partial and incomplete manner, usually focusing on cash transactions and personal accounts of debtors and creditors. This system does not follow the principles of double entry and therefore does not provide a complete record of business transactions. Profit or loss is generally ascertained in an indirect manner, usually through the statement of a face, and the financial position shown under this system is only approximate, not exact. The single entry system is mainly adopted by small traders and petty businessmen because it is simple, economical, and easy to maintain, though it lacks accuracy and legal acceptance. Nature of single entry system. It is not a complete system of accounting. It records mainly cash transactions and some credit transactions. It depends on the convenience of the businessman. It does not strictly follow accounting principles. Accounts maintained under single entry system. Cash book, generally maintained. Personal accounts of debtors and creditors. Real and nominal accounts are not fully maintained. Capital account is prepared only at the beginning and end of the accounting period. Features of single entry system. One-sided recording. Only one aspect, either debit or credit, of a transaction is recorded. Absence of fixed rules. No standardized rules of debit and credit are followed. Incomplete accounting records. Many transactions remain unrecorded. No trial balance. Due to absence of dual recording, trial balance cannot be prepared. Profit determination through statement of affairs. Profit or loss is calculated indirectly. Lack of reliability. Financial statements are not accurate. Ascertainment of profit under single entry system. Profit or loss is determined using the statement of affairs method where profit or loss equals to sum of closing capital and drawings minus sum of additional capital and opening capital. This method provides only an approximate result and not the true profit or loss. Advantages of single entry system. Simplicity. Easy to understand and operate. Economical. Low cost of maintenance, no need for trained accountants. Less clerical work. Fewer books and records are required. Suitable for small businesses. Ideal for petty traders and small shopkeepers. Disadvantages or limitations of single entry system. Incomplete records of transactions. True profit or loss cannot be ascertained. Financial position shown is unreliable. No check on errors and frauds. Not legally acceptable. Unsuitable for growing and expanding businesses. Introduction to double entry system. The concept of double entry is based on the principle of duality, which has existed since the beginning of business. However, the modern double entry system was formally developed in 1494 in Venice by Luca Pacioli, through his book Summa de Arithmetica, Geometrica, Proportioni et Proportionalita. Luca Pacioli is regarded as the father of modern accounting. Concept of double entry system. Meaning and definition. The double entry system of accounting is a scientific and complete system of accounting in which every transaction is recorded into accounts, one as a debit and the other as a credit. According to Luce, double entry system is a system of bookkeeping which recognizes that every transaction has two aspects. Principle of double entry. This system is based on the principle of duality, which states every transaction affects at least two accounts, and the total of debits must always be equal to the total of credits. Accounts maintained under double entry system. Under the double entry system of accounting, all business transactions are recorded completely, following the dual aspect principle. For this purpose, three types of accounts are maintained. 1. Personal accounts. These accounts relate to persons or entities with whom the business has dealings. They include accounts of debtors and creditors, accounts of customers and suppliers, capital account of the owner. 2. Real accounts. These accounts relate to assets and properties of the business. They include cash and bank accounts, furniture, machinery, buildings, stock, investments, etc. 3. Nominal accounts. These accounts relate to expenses, incomes, gains, and losses of the business. They include salaries, rent, wages, interest, commission received, discount allowed received, losses and gains. Thus, under the double entry system, personal, real, and nominal accounts are properly maintained, which ensures accurate recording of transactions and enables the preparation of trial balance and final accounts. Features of double entry system. Dual recording of transactions. Scientific and systematic method. Complete record of all transactions. Preparation of trial balance. Preparation of final accounts. Uniformity and consistency in records. Ascertainment of profit under double entry system. Under the double entry system of accounting, profit or loss is ascertained in a systematic and accurate manner. Since all business transactions are recorded with both debit and credit aspects, complete accounting records are available. At the end of the accounting period, nominal accounts relating to incomes and expenses are closed and transferred to the profit and loss account. The profit and loss account is prepared after the trading account, which determines the gross profit or gross loss. If total revenues exceed total expenses, the result is profit. If total expenses exceed total revenues, the result is loss. Because the double entry system follows proper accounting principles and maintains complete records, the profit or loss ascertained under this system is true, accurate, and reliable. This method provides a correct measure of business performance for the accounting period. Advantages of double entry system. Complete and accurate records. True profit or loss can be ascertained. True financial position is determined. Errors and frauds can be detected. Legally accepted system. Helps management in decision making. Facilitates comparison of performance. Disadvantages of double entry system. Complex system. Requires accounting knowledge. Costly to maintain. Time-consuming process. Difference between single entry system and double entry system. On the basis of overview. Only one effect of transaction recorded under single entry system, whereas both aspects of transaction recorded. On the basis of object. Cash, debtors and creditors balances are recorded under single entry system, whereas every financial aspect of business under double entry system. On the basis of type of recording. Incomplete recording is done under single entry system, whereas complete recording of transactions are done under double entry system. On the basis of fraud. Easy to hide fraudulent transactions under single entry system, whereas difficult to hide fraudulently transactions under double entry system. On the basis of error. It's hard to detect errors under single entry system, whereas it's easy to detect errors under double entry system. On the basis of accounts included. Only personal and cash accounts are recorded under single entry system, whereas all types of accounts, personal, real, nominal, are recorded under double entry system. On the basis of taxation acceptance. Accounts done under single entry system are not accepted by tax department, whereas account done under the double entry system are accepted by tax department. On the basis of profit loss for the year. It's difficult to calculate profit under single entry system, whereas it's easy to calculate profit under double entry system. On the basis of suitability. Single entry system is suitable for small businesses, whereas double entry system is suitable for all types of businesses. Conclusion. So, that's all about the single entry system of accounting. We understood its meaning, how it originated, its nature, features, and why it is mainly used by small traders. While the single entry system is simple and economical, it does not provide accurate profit or a true financial position because it records transactions only in a partial manner. This system may be suitable for small businesses, but as a business grows, it becomes essential to adopt a more systematic and reliable method of accounting. In the next video, we will move on to a very important topic in accounting, where we will clearly understand the double entry system and the rules of accounting, which form the backbone of modern accounting. If you found this video useful, don't forget to like, share, and subscribe to the channel. Thank you for watching, and I'll see you in the next video.